Welcome to a video that I like to call the deep dive video, and I feel I need to explain this. The context of deep dive is a little bit different than you might have thought when you saw this thumbnail. Every week I do a number of videos. I do a video each day, I do a weekly video, I do an intermarket analysis video. The last video that I do over the weekend is I go through all of the charts and I pick out those that I really didn't use in any of the videos, specifically daily charts. There are also a list of charts that are specific just to this video itself that I really don't use in any of the other videos that I post. The idea is to get some insight as to what's happening in the market that's not really blatant or staring us right in the face right now. And we can get that by looking at the context of the videos in this chart and comparing it with the videos in the other charts. So even though this might be an interesting video to you, it's not meant to be a standalone video. It's meant to be used in conjunction with the other videos, specifically the daily videos that I post. This is being prepared for Tuesday, February 20th. The first chart that you see here is a chart of the VIX, even though the VIX is invisible on this chart. When the VIX was first created, they like to use static numbers with the VIX. 12 to the downside, that means there's no fear in the market. 20 to the upside, that means there's a lot of fear in the market. Well, sometimes those static levels don't work all that well. The VIX can be more dynamic than that. And so what I've done with this chart is I plotted a 50-period exponential moving average on top of the VIX, and then I made the VIX itself invisible so we only see the moving average. And you can see back in 2007, we shot up when we were going through the great financial crisis, and we started to see a higher range for the VIX. Then as the market was bouncing back up and improving, we went down and set a lower range. And then when the COVID plunge happened, we shot back up and hit a higher range. And now that stocks have been improving, we've been possibly setting a lower range. We don't necessarily use this to make decisions. This is just used for reference to give us an idea. What is the VIX doing in a bigger picture, longer term type of view? Then I did show this over the past week because we had a big down day on Tuesday when CPI came out and it was stronger than expected. And so stocks went down. That means the VIX went up, and we did get an extreme positive reading there because this goes the opposite way of stock movement. But then as we spent Wednesday and Thursday bouncing back, the VIX started to come back down. So I only showed it that one time. This tries to measure how fast is the VIX moving by using an RSI based on 9 periods. Then we look at another thing called the MOVE index, and that measures the volatility of bonds. Then in the middle area is the VIX, which measures the volatility of stocks. I try to do a little study here in between where I take the VIX and subtract the MOVE index. That's the green line. The red line is the S&P 500. Right now, we can see that their correlation is pretty strong between the top chart and the middle chart, meaning that stocks and bonds are tending to, on a volatility basis, go in the same direction at the same time. Then we also do another study. We look at the VIX, and then we look at a thing called the VVIX, which is the volatility of the VIX, and take a ratio of that. And in a general sense, when this is going down, that means the VIX is going down, and that tends to be more positive for the market. When this is going up, that tends to be more negative for the market. And we were coming down as stocks were rebounding in late 2023, but now we continue to go up. It takes quite a bit of time for this to reverse its direction here. So if we do keep going up with stocks, this would eventually turn down, but it hasn't turned down at least yet. Then we look at a ratio between the VIX and the MOVE index. And when this is going up and the moving average is going up, that just means that stocks are more volatile than bonds. This is really more for informational purposes too. Then this is a new chart, and I've been watching this chart for a long time. I've used it for years. I just haven't shown it in any videos. I may start incorporating this in maybe the daily videos, possibly the weekly videos. This measures the momentum of the VIX, whether it's going up or down. When the VIX is going up, that means the stock market is usually under pressure. That means fear is increasing, and that means that stocks are going down. Then when the VIX is going down, you can see the general momentum is going down as well as stocks are going up. And what we've been seeing for since about the last part of November into early December is we've been seeing the VIX on a momentum basis increase with its momentum, as slowly but surely over time, the VIX has been going back up slowly. Just something to be aware of. We've been very low with the VIX, but this is suggesting that the VIX is starting to go up a little bit higher as we're seeing a little bit more volatility. Then we also have another fear gauge where I compare bonds with investment grade bonds to get some kind of fear versus greed type of measurement. And this one hasn't been all that helpful lately. Usually when this is going down, that means fear is decreasing. When this is going back up, that means there's an increase in fear. And maybe it is telling us something, but it's not necessarily lining up with some of the other fear gauges that we follow. There's another fear gauge. When this is decreasing overall, that means that fear is decreasing as well. And we're getting a very low reading when we look at this ratio. That also is confirming what we're seeing with some of our other fear gauges that we follow. And this has been kind of disappointing lately. This is risk on versus risk off. We have high beta stocks. These are the stocks that tend to outperform the market, the mega caps, the stocks that most people have heard about. When we're really going up with stocks, the high beta stocks tend to outperform. When we're having a little bit more problems and maybe going sideways and even declining, folks will get out of the high beta stocks because they not only outperform the market on the way up, they can go down faster on the way down. And so people tend to bail on those pretty quick. And then they might jump into what are considered to be more conservative stocks that are represented by the equal weight S&P 500. And when this ratio is going up, that means that we're in a risk on. Folks are willing to put their money at risk, get into these higher risky investments with the anticipation of getting a better return. When this is going down, that means they're more risk averse or they're risk off. They're getting out of the riskier stocks and getting into more of the conservative stocks. Well, we were starting to go up into the end of 2023, and then we've been just chopping around right now. We're not getting any kind of a real sustained reading in one direction or the other, so I haven't been showing this chart. Then this is just for informational purposes. We have the all-time high that was set early in January of 2022. And then we finally went back and set a new all-time high. And since we're above that, we're 3.88% above the previous all-time high set for the S&P. Then we look at a number of different advanced decline lines. And I show this one off and on. I actually showed this chart a couple of times in the daily videos. On top, we have a cumulative advanced decline line for the NYSE. And that just, it's like a running total. And when we have an up day, this has a tendency to really spike up. When we have a down day, that really spikes down. And that can give us a little bit different of a read than what we see down on the bottom. This is more of a traditional advanced decline line where it is going up, even though we did come down a little bit in Friday's session. And I show this off and on, usually when we see a big move up or a big move down. And since the move was rather muted in Friday's session, I didn't show this chart, at least for that video. Then we're also comparing common stock. We look at the advanced decline line based on price above, where we came back to this previous high and we've been falling back. And then we also look at volume, because price is ultimately the most important thing. But volume can also give us some insight as to what's happening. And you notice we're coming back to this previous high based on price, but we've not come back to this previous high based on volume. So this is producing a bit of a negative divergence. Now it's shorter term, but the longer this goes on, the more negativity that may bring into the market. Then we have a thing called technical alerts, which are put out by stockcharts.com. And I've been showing these again each day for the previous day when I do the video. But this is for the whole week. And we start this by reading at the bottom. This is Monday, and then it goes all the way to Friday. When they're red, that's negative. When they're blue or green, that's positive. When we have a down day, we see a lot of red. When we have a lot of green or blue, that tends to be positive. And so we can just kind of look at this on a color basis and say, oh yeah, things are kind of positive right now. I do follow these as they're generated, but then you can kind of see the bigger picture look here by getting an overall feel for how the market is either going up or down. And this looks at other things outside of the S&P, different sectors, different indexes, even different markets. Then we have 5 main indexes that I follow. The S&P is the backbone of everything that I teach about and all the strategies that I do and I also teach about. But we want to know, how is the S&P doing in relation to other indexes out there? And I've broken it down into 5 main indexes. We have the S&P, of course, and then the QQQs, which is the NASDAQ 100. Then we look at the diamonds or the Dow. Those are the 30 biggest blue chip companies. Then we look at the mid caps and the small caps. Stock charts has this ability to rate them on a score from 0 to 100. The higher the number, the better looking the technical chart. And then I rank them, what's coming in first place through fifth place. And coming in first, which has been the same for quite a while now, are the QQQs. That's the NASDAQ 100, and it has been doing the best. Now, it had been up into the 90s, but we're dropping off a little bit as we saw a bit of profit taking this past week. This score is coming in at 89.3. In second place is the S&P 500. There are a lot of stocks in the NASDAQ 100 that are also in the S&P 500, but since there's more stocks over 500, there's also a lot of value stocks in there as well, and it gives more of a representation of the U.S. economy, but it's coming in second place at 82.4. Then in third place are the diamonds. These are 30 companies and considered the bluest of the blue chip. It's coming in with a score of 71.1, where it did tick down a bit. And here's a little change that we're seeing. In fourth place are the small caps. They've been in last place for, it seems like, forever. Then they shot to first place when we were seeing a real upward move in December, and then they went back into last place. But they're actually outperforming the mid caps right now, as we have been seeing some improvement overall. They come in with a score of 69.2. And then in last place are the mid caps at 67.1. And under the surface, the mid caps are holding up a little bit better. But we've been seeing some recent strength in the small caps. We're wondering if that's going to continue, because with the small caps, we have a one or two really nice upward moves, and then we spend the rest of the week or the next 3 or 4 trading sessions giving back a lot of those gains. And it's like a lot of false breakouts, and that can be very frustrating. We were supposed to have a thing called the January effect, which only lasted for the month of December. It starts in December, and it's supposed to carry over into January. Well, it didn't. Right when we got into 2024, we started to see a lot of weakness in the small caps. And so that's been really frustrating for a lot of folks that were anticipating that. Then we have some short-term charts. The first one here is a rainbow going from 10 periods to 50 periods with a simple moving average. And I look at all of this, all the way from over on the left to the right. I try to take in the whole picture all at once to get a big picture look, even though these are shorter term moving averages. And we can see that price is still above all of the lines, and the lines are going up. So the short-term trend is currently positive and staying positive for right now. This often shows up in the daily videos. This is the Stoch RSI. It tries to take the idea behind a stochastics indicator and an RSI and put them together. Well, it's a very touchy indicator. And so we move in one direction or the other. You can see here near the end of January, we went from extreme positive down to extreme negative in one day. Well, the last week or so, we've been a little more choppy, and so we haven't been getting any kind of extreme readings the last couple of days. It did go extreme negative there when we had the big down day on Tuesday, but since then, it's been just chopping around in the middle. Then we have another short-term indicator. I have 2 of these. I have a commodity channel index, or CCI, based on 20 periods. That's a little longer. And then this one, which is the CCI based on 14 periods. This had been extreme. It's falling back down, but it still hasn't come back up to being extreme yet. Where the CCI based on 20 periods, that is a chart that I'm showing in the video right now, because it's still extreme positive. It takes a little longer for that to move. Then we have a double and triple exponential moving average study. And this one is based on 20 periods, and that draws a green line and a blue line. And right now, we did fall down below this when we had the down day on Tuesday, but we've come back up, and we're right about on both of these lines. This just gives us an idea of when the blue line is above the green line, that means the trend is really strong, because the triple moves faster than the double. When we're starting to see a little bit of weakness, or maybe things just kind of slowing down, then the green line will drop down below the blue line. It's kind of hard to tell what's happening right now. And then we have a regular 20-period moving average study. And I did show this a time or two in the past week, because when we had the big down day on Tuesday, we came all the way down to the exponential moving average, which is just about where the simple moving average is. And I get asked this all the time: what's better, simple moving average or an exponential moving average? I'm like, both. Okay, they both have their strengths and weaknesses, so I plot them both on here. We can get a little bit of additional insight from this chart. When the blue line is above the red line, that means we're moving quicker. That means the exponential moving average, which is calculated weighted more towards current prices, where the simple moving average treats all 20 prices the same. When this is going up, that means we're going up faster. Then we also use this as support when we're falling back, and we can see that price is above both the blue line and the red line. So that is also suggesting that the trend remains positive for right now. Then we have an intermediate term rainbow. This goes from 50 periods up to 100 periods. The same basic idea here. I try to take in the whole chart together. We can see that price is above all of the lines and the lines are smoothly going up. So the intermediate term trend is still positive. Then we have the same basic idea with the double and triple exponential moving average study, but this is based on 50 periods. So the lines get a little further apart. The red line is above the blue line. That means we're going up quicker. And sometimes when we have a bit of a pullback, this will act as support with the blue line. When we break out above this, that means that we're really moving higher with some velocity. Right now, we're right in between the two, and it's still showing that the more intermediate term trend is still positive. Then we have an anchored moving average, not really a big use for this right now. Most moving averages take you from right now, and then you calculate backwards. Well, with an anchored moving average, you can go to a previous price and then have it calculate going forward. And this became pretty critical last October when we were really going down. We actually broke below this and we were able to get back above it. And then we just really bounced up off of that. And since we're far away from this line right now, I haven't been showing this chart because I have a couple of other ones here that are anchored back to the COVID low that we hit back in 2020. This is a Connors RSI, which is another type of oscillator. This gyrates around quite a bit day to day. What we look for is an extreme positive or negative reading. We're not getting that right now, so I haven't been showing that chart. Then we have a 50-period moving average study where we can see here that the blue line is just barely above the red line. So that means we are still seeing a pretty solid trend right now when we look at the 50-period moving average study, and prices above both and everything is going up. So that means that we're seeing a pretty solid intermediate term trend. A little further out is a 100-period moving average study. The red line is above the green line and prices above both. So a little bit more longer term, intermediate to even possibly long term. This is also suggesting that the trend is higher or positive. Then just for informational purposes, we measure how far away are we above or below the 200-day simple moving average. We're green, even though we dropped a little bit this past week. We're currently up 11.6% from the 200-day simple moving average. This is standard deviation. This doesn't measure direction. It measures speed or velocity. When a stock is going up really fast, we'll get a really high reading with standard deviation. If it's going down really fast, we'll get a really high reading. Right now, as we've been chopping more or less sideways over the last few days, this only goes back the last 10 periods, and we're dropping below the moving average. So this shows that we're not really moving all that quickly right now. Then we have the mass index. This is not generating a signal. We pay attention to this when we get up above the red dash line and the blue line and then turn back down. That is a signal that sometimes can help us, especially when we've been going down pretty heavily, but it's not generating a signal currently. And then we keep an eye on the S&P 100, which is in the bottom. Those are the biggest stocks that make up the S&P 500. And we just kind of look for different divergences here. We're not really seeing anything. They're matching each other. In fact, as should happen in a more solid environment, the S&P 100 is outperforming the S&P 500. And so we're not really seeing anything that's causing any concern right now with this chart. Then there's some measurements, and I do this myself, so they may not be exact. The one that I've been focusing on lately, this goes from, we hit a high in July of 2023, and then we started going down. Then we hit a low in October of 2023. And so far, we've been bouncing up out of that and setting some new all-time highs above 5,000 with the S&P. And this just measures the percentage change that we're seeing in that move. And we have a thing called Bollinger Bands, and you can use these a lot of different ways. This is positive right now because we have this dashed line in the middle. That's the midpoint, and prices above that. Price is also going up, and the midpoint is going up. That's one way to use this. We can also look at the width of the Bollinger Bands, and when we're really moving quickly, the width gets pretty wide between the two. Another thing that we see is there's a very small percentage of the time when we close above or below the upper or lower Bollinger Band. And the percent B indicator, that's what this tries to measure. The very small part of the time when we are extreme positive or extreme negative. We're not extreme right now. Now, you could still say this is positive because we're above the midpoint, even though we did decline a little bit in Friday's session. Then this is supposed to be a standalone trading system. I don't use it like that. I use the CMB composite like an oscillator. When we get above this black line, we're extreme positive. When we get below this black line, we're extreme negative. Right now, we're not extreme, so I haven't been showing this chart. Here's a point and figure chart. This does not take time into account. This just measures price movement, whether it takes an hour or a year for price to move. If we go up, that produces an X. If we go down, that produces an O. And we haven't seen anything new drawn in here recently, but there are some signals that are generated from this chart. We had a double top breakout on November 20th. And that was the last signal, and that's a positive signal. And right now, since we have the trend lines underneath here, this chart is still looking positive. Then we have a Pring bottom fisher. It's trying to cross over and give us some kind of a signal. This indicator works best when we're just really moving down pretty significantly. We're getting oversold. Everybody's panicking. We're afraid that the market's going to be falling apart forever and it's never going to go up again. And when we start to see this line cross above the red line, that produces what could be a buy signal. We don't use it by itself. We use it in conjunction with other charts. But right now, since we've been going up, I haven't been paying attention to this chart at all. A long-term chart, first we have a longer-term rainbow going from 50 periods up to 250 periods. The same basic idea. Price is above all of the lines in the rainbow, and all of the lines are going up, and we're far away from these lines, suggesting the long-term trend is still positive. Then we have a daily special K chart, and I talk about this. I mention it in every daily video, but we don't get a lot of signals from this chart. We might get one, maybe we got one in 2022. We had 3, maybe 4 signals in 2023. So I just mentioned this, but I just show the chart in this particular video. And it's a long-term oscillator, and we're above this red line. So our longer-term trend is also positive according to this chart. Then we take a look at the S&P 500 weekly chart on top, and then the German weekly chart, the DAX, that's their index, in the middle area. And we see right now there's a pretty strong correlated relationship between the two. The higher this reading, the more correlated they are. For a while, they were almost going in opposite directions of each other, or they were at best neutral. And sometimes we can take a bit of a lead by what's going on in Europe. And Germany has the biggest stock market in the EU. So we kind of want to keep an eye on that. And if they're doing really well, chances are the S&P may follow through as well. Then we look at the 10-year yield in the US and we subtract the German 10-year yield. And because US rates are higher, that gives us a positive result. That's the red line. Anything above the red line is positive. And sometimes we can plot the US dollar index down here and we can see that there's a correlation between the two. Now, lately, there really hasn't been a strong correlation, but it is getting a little bit stronger. If we get back up into this blue area, we might be able to get some insight as to what's happening with the US dollar based on what's happening between US interest rates and German interest rates. Then there's some other support and resistance areas. This is an indicator that I developed a long time ago. I call it a mini rainbow, and it's a 20-period simple moving average of the open, high, low, and close. And we're above all of the lines in the mini rainbow. You can see in Tuesday's session, this actually ended up acting as support, and that's usually what happens. Now, it's positive because all the lines are going up and price is above the lines. But sometimes when we're going up and we fall back, one of these lines may act as support. When we're going down and we start to bounce back up, one of these lines may act as resistance. So this can be a useful tool, but right now price is quite a bit of ways away from the mini rainbow, so I haven't been showing this chart. And then for the last year or so, the 50-day cycle has been kind of helpful. I went from the COVID low and went, oh, wow, there's a high here. There's 50 days from here to here. Okay, let's project that forward. And we'll have to see that this is not anything to use to make decisions off of. This is just for informational purposes. We did have a new cycle that started on January 2nd. We went down, but since then we've been going back up. We're going to have another new cycle generated here in March. We're still a ways away from that. But I usually warn about this in the daily videos before it's going to happen. But again, it's not necessarily something that we use to make our decisions with. Ichimoku cloud can also provide support or resistance. And all this is a set of moving averages that are shifted forward based on current price. When the cloud is green, that's positive. When it's red, that's negative. And when we are going up and we start to fall back, part of this cloud may act as support. When we're going down and we start to bounce, part of this cloud may act as resistance. And a lot of folks use this, especially when you're trading in the Forex markets. This is a Fibonacci retracement level. The only reason I'm showing this here is we have not come back and set a new all-time high with the NASDAQ, and that would make things more positive. Now, is that going to happen? We don't know. We don't know if it's going to happen this week or even this year. But for right now, we're not too far away from this all-time high. That would confirm more of the all-time highs that we're seeing in the NASDAQ 100 and the S&P 500, as well as the Dow. And this is a broader market measure, so that would suggest that the broader market is doing better. Then this is an arithmetic scale. Most of the charts that I show you are based on a log scale. Just for kicks, one day I switched it over and said, oh, what's happening here? And I went back to 2009, and I tied this low to this low and then just shot the line forward and went, wow, that's kind of interesting. Look at how we had some overhead resistance here. We came up to this point, went back down, came up to this point. This was right when the COVID plunge started. We hit this resistance and then tanked. And we were finally able to break through that. And now once this has been broken through, what was once resistance now becomes support, and not all that great. We did fall back down through it. It became resistance again. But if you look all the way over on the right-hand side, we're well above this line, so I haven't been showing it. Then we look at some broad market measures. We're keeping an eye on the financial sector. There's a regional bank, the New York Community Bank, that came out with some problems. And it's been almost a year since we had some banking problems develop in the market, and that freaked out the market for a while. We want to keep an eye on these charts in case we start to see more banking problems hitting the news. When we were coming down, this is a pretty solid level of support. It had been resistance, but then we broke through it and then it became support here, and we're far away from this, so there's been no need to show this chart. Then I've been talking about this all the time, but this is longer term. We're seeing a negative divergence between the Dow and the transports. And the red line is the transports, the black line is the Dow. They're far apart from each other, and the red line's underneath the black line. And so I haven't been showing this because I'm just kind of repeating myself day after day, but I do include this in the bullet points with each daily video that I put out. This is called the Vixen, where the S&P 500 has the VIX, that measures volatility. The NASDAQ 100 has the Vixen. Now, the bar chart here is kind of crazy with all these icicle-looking things here. I mainly follow the line chart, but I will warn you, I mostly follow the VIX because I'm focused more on the S&P 500. When this is going down and we're following the moving average, that means fear has been decreasing. Lately, as we've been seeing a little bit of pressure on the NASDAQ 100, this has gone back above the moving average. When we look at a ratio between the Qs, which is tech, and the Dow, which are blue chip, established, well-known companies, and we see that they did have a pretty strong relationship between the two, but now that's starting to weaken just a little bit. We want to keep an eye on the bank ETF. So we're watching the bigger picture by watching the financial sector. Then we break that down by looking at the bank ETF. And this had been going up enough to establish a new uptrend, but now it's been under a little bit of pressure as this news has been hitting the market. But we're still in that uptrend. And we break this down a little bit more. There's a regional banking ETF, and we compare that with the financial sector. And when we broke a year ago, this really came down and we've been chopping sideways. Near the end of 2023, this started to go back up enough to generate a golden cross with this ratio. But then the New York Community Bank information or news hit and we shot back down. And right now we're currently underperforming. We're waiting to see, are there more banks that are going to come out? That's kind of what we're waiting to see right now. Then some rate of change charts. These are just for informational purposes. These are long-term. This goes from Friday's close and then goes back 250 trading periods where we've been chopping more or less sideways, but we're still positive longer term. We're also chopping sideways and still hanging in there okay with this chart. Then we want to keep an eye on bonds, where we look at 1 to 3 year bonds and we compare them with 3 to 7 year bonds. If you think interest rates are going to go up, you're going to get into shorter term bonds. You're going to get into the 1 to 3 year bonds because you're not going to hold on to them as long. And when they mature, you can then roll them over into a higher interest rate. Well, if you think interest rates are going to start coming down, then you want to start getting into 3 to 7 year bonds. You want to lock in a longer maturity at a higher rate because you think interest rates are going to come down, but you've got this higher rate that you've locked in. And we've been on a seesaw course over the last year with this. This looks like we were really starting to go back up, and this means that interest rates were starting to go back up. And that was really spooking the market. This is when the market was really starting to think maybe the Fed's done raising rates, maybe they're going to cut rates, maybe we're going to have a soft landing, everything is fine, everything is wonderful. And then this started to shift over the summer months, and we saw this ratio really going up. And we hit a bottom in October. That made this ratio start to go back down. And that's where we saw the nice run up into the end of the year. Well, now we're starting to go back up again as the market is a little bit uncertain about what the Fed is going to do with interest rates. Here's an inverse of that same chart. When this was going up, that means that there was uncertainty, and now it's starting to go back down. I'm sorry, there was more surety here. There's more uncertainty right now. Then we look at the TLT, which is the 20 all the way up to 30-year bond ETF. That's in blue. And we have the S&P, which is in red. And you can see that kind of going in opposite directions here. And their longer-term relationship is really starting to not be as strong right now. Although when we look at a shorter-term relationship, it is starting to improve, but it's also not all that strong right now. This is more for information, just to kind of give us an idea. Are stocks and bonds going in the same direction or in opposite directions? Then we look at a ratio of the Qs, which is the NASDAQ 100 with the TLT, the bond ETF we just talked about. And for a while near the end of the year, they had a really strong relationship. Now that's starting to go to the point where they're having more of a tendency to go in opposite directions of each other. Then here's the yield curves. I plot a bunch of them on this chart, but the ones that the market really pays attention to is the 10 to the 2-year and the 10 to the 3-month. We're still inverted with both of these. It's been a couple of years with the 10 to the 2 and about a year and a half, I believe, with the 10 to the 3-month. We're just waiting to see if that's ever going to change. And then this looks at TIPS. These are Treasury inflation protected securities. This is what you get into when you're worried about interest rates going up. They're shorter maturities. They also adjust based on interest rates. And then when you think, okay, maybe interest rates have topped out and they're going to start coming down, I'm going to get out of TIPS and I'm going to get into longer term bonds. And that's what we've been seeing overall is this ratio has been going down. When interest rates were going up, we saw TIPS really outperforming. And lately, we've been seeing this more or less sideways, but still it's been going down. Where it's a little more pronounced is when we go further out, where we compare TIPS to 7 to 10-year bonds. TIPS were really outperforming as interest rates were going up. Then we chopped around for most of 2022. We started to go back up in 2023. And then when everybody thought, oh, great, maybe the Fed's going to be done raising rates, we saw this really going down. But now it's starting to go back up again as there's more uncertainty in the market. Then we look at cash, which is represented by a 1 to 3 month T-bill, and we compare it with 3 to 7-year bonds. When this is going up, that means there's a lot of uncertainty about interest rates. And then over the summer, late spring into the early summer, we saw this really coming down. Well, then everything switched when the market got caught off guard, and this ratio really started going back up, suggesting there was more uncertainty. We finally hit a bottom in October, and then we've been coming down, but now we're starting to go back up again as there's more current uncertainty. Then we look at home construction. This is more positive than negative. Home construction is very interest rate sensitive. And would this really be outperforming if the home construction ETF was concerned about interest rates? No, it would be going down like it was last summer. It's going up. Yeah, it's fallen back a little bit and it hasn't set an all-time high in a week or so, but this is really performing quite well. This gives us more hope that maybe interest rates aren't going to be a problem going forward, at least according to this part of the market. Then we look at the S&P and we compare it with 3 to 7-year bonds, and we're really outperforming. This is showing that stocks are outperforming bonds. And when we're up in this area, that means that the market is suggesting that we might have a soft landing, which means, okay, we've seen some economic slowdown, but not enough to really go into a recession. Well, if we were really going down, that would suggest that the market thinks we're going to have a hard landing, which means, yeah, we're going into a recession. And this has pretty much been the story throughout most of 2023 and now into 2024 that the market is anticipating a soft landing. And then I have a number of charts that I use under the category of possible positive scenarios. These are really designed for when we're going down and we possibly have hit a bottom and we're going to start to bounce up out of that. But we can still use these on a day in and day out basis, but I don't use all of them. This one is the percent of stocks in the S&P 500 that are above their 200-day simple moving average. I do have another study that's very similar to this that I do show every day, but the way it's designed here is we can use this like an oscillator. When we get extreme positive or extreme negative, when we're above the midpoint, which is 50%, that means that we're more positive. But you notice how we've been coming down lately, even though it's been bouncing back up over the last few sessions. So we're still positive with this overall. Then we break that down a little bit more and we look at the S&P 500 with the stocks and compare them with their 50-day moving average. We can use this like an oscillator. We did get extreme at the end of 2023 and then we've been pulling back, but we're still above the 50 level now. So we're still positive. We also look at the mid caps. They went extreme, pulled back, showing a little bit of an improvement. And the small caps, extreme, pulled back, showing some improvement there. And then we have a 19-day exponential moving average of the advanced decline ratio. The top area is based on price. The bottom area is based on volume. This is still positive because we're above the zero line, both based on price and volume. We can use this like an oscillator when we get an extreme positive or negative reading, but we're not getting that right now. Thank you. I really hope you found this helpful. Please feel free to check out some of the other videos that I post. I hope you're having a great weekend, and I will talk to you in the next video.